Good morning, it's Monday, and this is Deconstruct, a podcast by The Real Deal. I'm Isabella Farr.
And I'm Susanna Kavanaugh. And today we are taking a wide angle look at the housing market. So we're talking macroeconomics, looking at what is going on with the Fed's interest rate hikes and how it's impacting housing sales and prices.
So at the end of September, we saw this 75 basis point increase, which was the third such hike this year. And that's a really big deal. Typically, when the Fed raises interest rates, it has favored more conservative bumps, coming to around 25 basis points or so.
Right. But at this point, Fed Chair Jerome Powell is just on a tear to tamp down inflation by any means possible. So he's raising rates by the fastest pace we've seen in decades because after 6 months of hikes, the consumer price index has barely budged.
Right, it really hasn't. The most recent CPI report in August, which is basically a snapshot of the US economy, showed the annual inflation rate clocked in at 8.3%. That's down just 0.2 of a percentage point from July.
Mm-hmm. So we're going to get the next report this Thursday, and we'll have a better sense of whether Powell's attempts to bring inflation down are actually panning out. Some are speculating that the Fed chair has been a little too aggressive with hikes. So their worry is that he just isn't giving the monetary policy enough time to settle and see if it's working or not. The fear could be that the bumps might slow economic growth too fast. And in that case, we'd need an interest rate rollback.
And in the meantime, the housing and rental markets are really just stuck in the middle. And just as Powell's interest rate rises have yet to tamp down inflation, they also haven't yet brought relief to tenants or would-be homebuyers. Rent growth is starting to slow, but not enough to cool down inflation numbers, and home prices haven't dipped all that much.
Yeah. So if we're looking at the housing market and the rental market, there's all these juicy contradictions sort of brewing. But first, let's get into the news.
So, our October magazine issue dropped last week. The cover story breaks down Compass's fall from grace and its hope to save its plummeting stock price in a pretty shaky market. But the latest drama to come out of the Compass camp is that the brokerage may be the target of a private equity takeover. That's according to a report from Business Insider. But Compass has since denied that a sale is in the cards to TRD's Hiten Samtani, saying, quote, there have been no talks with private equity firms on this matter.
Mm-hmm. Yeah. So I think Compass reports earnings in about a month. So that should be an indicator of where things are heading with them.
Yeah, we'll definitely be following them.
We will be following. Yeah. Teaser. So also in the magazine this month, we looked at how Airbnbs are still flying under the radar in New York City. It is illegal to rent a unit for fewer than 30 days if there is not a permanent resident staying there, both by state and city laws. So that makes Airbnbs not okay by either metric. But if you look at Airbnb, say you're booking a flight to New York or something like that, you're going to find thousands of listings. In most cases, what a reporter found out is that the tenants and owners who list those units know that they're breaking the law. The thing is, there are just too many of them for the city to catch. It's just too hard.
Right. I actually helped Nisha Shetty, a former reporting fellow for us, on that story. And an Airbnb host that she had contacted a couple of times for the story had actually blocked her on the platform and didn't respond to any of her questions. So it seemed like a really tough one to report. So I give Nisha a ton of kudos for that story. It was definitely tough.
Ooh.
So, meanwhile, on the other side of the country, renters in Los Angeles will finally wave goodbye to pandemic eviction protections. The city of LA has had one of the longest eviction bans in the country. It's still going on today. But the LA City Council has officially voted to end its moratorium on February 1st of next year. The move will allow landlords, some of whom haven't received rent since the beginning of the pandemic, to start suing their tenants for those arrears.
There's a bit of a catch, though, or we could characterize it as a trade-off, I guess. So the moratorium is ending, but at the same time, the city is expanding its just cause eviction protections to all city renters. Before, they were only available to tenants in rent-stabilized apartments. It's probably going to spark a bit of jealousy among New York renters. So tenant advocates in New York had pushed to pass good cause this year, which is a similar law. Basically, if you're facing eviction, but your landlord has raised the rent by 3% or 1.5 times the inflation rate, you have a defense in housing court against that eviction. But the bid to pass that didn't gain enough traction in the state legislature, so it flopped this year. There is a shot of it passing next year. It seems like tenant groups are sort of rallying to push it through, but we'll have to see what shakes out in the next legislative session. That's in January.
Yeah, it'll be interesting to see whether or not the events in LA will influence New York at all and, the decision of legislators.
Mm-hmm.
So, as we all know pretty intimately by now, giant rent hikes have defined the rental landscape across the country this year. But now we're seeing more and more evidence that that growth is finally slowing, as I mentioned briefly before. After the appraiser Jonathan Miller, he's someone that we've also had on the show before, released a report that New York City rents in August may have flatlined, StreetEasy actually found that the median rent in September had dropped $75. And I know that that doesn't sound like much, but after months and months of record-breaking prices, it's certainly a shift.
It's something.
Exactly. It's meaningful. And what was also interesting was that concessions from landlords seemed to be ticking up too. StreetEasy said landlords were more likely to offer concessions and discounted asking prices last month than they were in July.
Yeah, so both are early signs of a slowdown in the market, and we're seeing the same thing nationally. So RealPage, which is an analytics site, reported that rental demand in the third quarter went negative. And what that means is there were more people moving out of their homes than there were moving in. That's a big deal for a number of reasons. So for one, the third quarter is typically the busiest rental month. July through September, you're seeing warmer weather and people are taking the break from school, if you're a parent or a student, to move house. Also, this quarter, the fact that it was negative demand, that was the first time in 30 years of data that we've seen that, which is remarkable. And what the report found was that there were fewer move-ins, meaning that fewer households were being formed. So if you think back to right after vaccines rolled out, a bunch more households were being created because people who were living with roommates or who were at their parents' house were like, okay, there's COVID deals, I'm going to go ahead and get a 1-bedroom. That made more households. But over the past 3 months, people are not taking that leap, I guess we could say. They're just sort of buckling down.
Yeah, I thought that was really interesting. The report's author, Jay Parsons, really believes that people are delaying moves because they're worried about the future. Inflation hasn't cooled. Recession seems imminent, even though no economist can really agree on when that could happen or what that really looks like.
Yeah, but the whispers are there.
Right. And people are facing higher prices. And now with so many companies making layoffs, there's also the threat of losing their job. So people aren't taking risks. Most people are entering this mode of let's wait and see.
And that folds really nicely into our housing market chat. So consumer sentiment is slipping around housing sales also, and the Fed is partially to blame. So Fannie Mae has this index that registers how willing people are to buy or sell their home. And in August, that index fell for the 6th consecutive month. What it found is that sellers in particular are nervous about putting their house on the market because prices are so high and mortgage rates just keep rising.
Right. And that is counterintuitive, right? The fact that prices are still so high. Because typically when mortgage rates rise, it drives down housing prices because there is less demand among prospective buyers. Fewer people are going out and actually obtaining mortgages.
Right. And that's just one of the contradictions I alluded to at the top. Basically, we are in uncharted waters with the housing market, which is also what Redfin's chief economist, Daryl Fairweather, laid out in your chat with her last week.